You're listening to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist. Welcome to our 81st episode. So I have just come back from a full month of travels through the US, Europe, and UK. And if there was one common topic I discussed with family, friends, and colleagues during the trip, surprise, surprise, it was inflation. But it was not just inflation. It was also things that stem from it, from interest rate increases to recession risks, housing market, currency market volatility, and of course, the war in Ukraine. So I think it's appropriate to resume our series after my month of being away with a dive in global macro. I'm very pleased for that to have with us Robert Dekle, professor of economics at the University of Southern California. Robert's specializations range from international finance to open economy and development, as well as economies of Japan and East Asia. In addition to academia, Robert has worked at the International Monetary Fund and was a visiting scholar at the Federal Reserve Board of Governors. Professor Robert Dekle, welcome to Kopi Time.
Thank you. Thank you. It's a real pleasure. And it's great to meet up with you again. Yeah.
I know. It's been a long, long time, Robert. And I hope next time we meet, it'll be in person.
Great. Mm-hmm.
Robert, normally we start our macro discussions with the US, and you're based in LA, so we have to talk a lot about the US, but I would like to turn things around a bit and start with a key area of your interest, Japan. So sitting here in Singapore, from the market side of the business, we have been struck by the extraordinary magnitude of yen depreciation we've seen this year. And as you well know, that many financial markets participants have been basically calling the yield curve control of the Bank of Japan unsustainable, but they're holding fast. So let's start with your perspective on Japan.
I think they're quite disconnected from, in terms of their monetary policy, from the United States and Europe. And I think the reason for that is that their view is that the domestic economy is still weak. The wage increases wages haven't risen that much. They're like 1.5% or so. And so the domestic economy is weak, and they need to continue their loose monetary policies to get the domestic economy to recover some more. And the inflation rates are there. It's not like 0.5 as it was like a couple of years ago, but it's still just a tad above 2. So it's a bit above their targets. At the official target is a little bit above 2, I guess. So it's sort of around that level now. And so it hasn't exceeded it by any kind of margin. So I think the authorities feel that their loose monetary policies is still justified at this point. The only concern there is the weak yen. It hasn't been this weak since the early 90s. And that has resulted in, given the high kind of dollar-based commodity prices and oil prices and other input prices, that means that those prices are coming in even higher because of the weaker yen into Japan, which is causing, they import a lot of their foodstuffs, for example, food and energy, and that's causing some problems for households, which their budgets are stressed quite a bit because of the high food prices and in terms of production, the high energy prices. So that's a concern, but there hasn't been intervention, and I don't think the exchange rate intervention has been taken very seriously. So I think of course, if they have to start raising their short-term interest rates, they can't maintain their 10-year rate at 0.5%. So that's going to have to go. So it's going to, whether their announcement of holding interest rates constant would be, or at least the 10-year rate constant, is going to depend on what they're going to do to the short rates. But they haven't raised it, but I think it all depends on the inflation rate as it starts creeping up toward 3%, 4%, even if the domestic economy doesn't improve that much, I think they're going to have to start raising it. The interest rate, yeah.
And in terms of the sustainability of the yield curve control, do you see any physical limits, or it is really going to be a bit of an intellectual exercise for the good of the economy? They'll give up. It will not be something that the market.
I think they would have to give up if they start raising their short rates. Yeah, absolutely. Yeah.
No, I'm just talking in terms of the quantitative, magnitude.
Will they? So it's 0.5. So they could say, okay, we'll make it 2%, 3%. That's conceivable. Yeah, that's conceivable. But I don't. It was all done to. So there's two things. One is was to stimulate the economy, kind of keep the long rates low, and the other thing is to have a certain gap between the short rates and the long rates to maintain the profitability of the banking system, right? Because banks make money on the yield curve, and they're an important part of the Japanese stock market and the economy. So in that sense, they could kind of bump both up at a certain point. But so that's certainly a possibility, but it's not as crucial as when they were suffering from near deflation. All this kind of came aboard because of that. So.
Right. They finally got what they wanted, but they got a bit too much of it, it seems like, very quickly.
Well, I'm not so sure if it's too much yet. That's the surprise of the whole thing, that it's a little bit of, it's the mystery continues, because as the rest of the world, Europe and the US have inflation rates approaching 9%, it's still just a little above 2 there. So, it's still a mystery there.
Right.
Yeah.
So, in terms of that mystery, is it because that, unlike the European or the US economies, Japan's fiscal support around the pandemic was not commensurately large? Or is it because they have a chronically large output gap and therefore producers still have no power to raise prices?
I think it's both. As you point out, the fiscal response was nothing like that in the U.S. Given their budgetary situation is quite dire. The debt GDP ratio is much higher, so they don't have the fiscal space to do that. And also the kind of general output gap and the recessed state of the economy owing to aging of the population and lack of productivity growth, TFP growth, things like that. Yeah.
So to that point that, TFP growth and aging and sort of structural decline in economic growth, you have been, writing about and following Japan through this entire phase. There were struggles to get out of the 90s crisis through various policies to the aughts and the tens. What are the broader lessons, Robert? I mean, sitting in Singapore, I see, Singapore has an aging dynamic, and as it sort of hits toward the frontier of production, almost certainly, structurally lower.
Yeah.
Europe has the same issue, perhaps even US. So what are your...
I don't know what positive lessons Japan could, the rest of the world could learn from it. I think the only lesson is that don't let your economy age so drastically. And that's hard to do with just pro-natalist policies. They like some European countries, Japan tried with certainly the Abe administration with giving essentially very inexpensive childcare and subsidies for raising the number of children, but that hasn't really worked that much. And I think what hurts the country is really the lack of immigration.
That's right.
And I think Japan has a lot to learn from Singapore. I think to sort of try to bring in talent from all over the world at various levels, like kind of physical labor and also intellectual labor, but they haven't done that. Although Abe has tried, and I think that's probably the biggest reason why they're suffering from an aging population that's more drastic than other countries. And I think so. I mean, what do you do when you have a population as aging as Japan? I mean, you have high debt. I think the policies that they took are sort of appropriate. You're not going to have a lot of risk capital prices going up in a situation like that. So, but you have deflation and debt. Sort of the JGB prices have been going up. So holding bonds have been a good asset choice, and holding money has been a good asset choice. So that's why the bonds found a ready market in Japan, their debt. So I think they've done about as given the aging of the population, they've done about as well as they could. Again, there's things like innovation policies and all that, but it's those things are always very hard to see. Although this new Kishida, the prime minister, is trying to promote more innovation by bringing back sort of more of the Japan Inc. Approach, where you subsidize industries and things like that, and that may bear fruit. But that era seems to have passed in the global economy. So I think the only lesson is that try not to get your economy aging, and be more open to the international economy. Bring people in, and but they. And I think Europe is going that way, and Singapore has as well. And of course, the United States has always been very open to mobility of human capital. And I think that's where it's been very hard for Japan to adapt, and they're kind of at their current difficulties there. Yeah.
Robert, you sort of talked about one of the consequences of aging as debt and deflation. I don't know if you read this book. It's Charles Goodhart and Mahmood Pradhan wrote this book a couple of years ago called The Great Demographic Reversal. And they have a sort of a provocative thesis, which is we should not look at Japan and take away that aging and deflation come hand in hand. Japan's deflation is more related to regional market liberalization over the last 2 decades, as well as China's exporting of low prices to the tradable sector. And their point is that as U.S. and Europe and other countries age, they will actually see inflationary impact because labor force shrinks and wage demand will actually pick up. Now, I mean, I have always been in your camp, because even in the IMF, when we wrote papers on demographic, the stylized fact common with aging was dissipation of price pressure. So what do you think of this pushback that it may actually be the other way around?
So they're arguing that wages are going to be increasing with
shrinking of the labor force,
a shortage of the working age population, and that I mean those. I think what's the Japanese lesson is that it's indeed true. The working age population has gone down, but that's been augmented by imports from China and the rest of the world. What's hurt is that the demand for Japanese products has gone down, like globally. Right, because of the competition from Korea and China and other Southeast Asian countries, and domestic. Well, I mean, still a large domestic economy, but the demand for Japanese consumption goods, such as cars, and also since the population is so aging, there's very little new household formation. So when you buy a house, there's all sorts of stuff that goes into that. If you build a house, material, but that demand's just collapsed. So home electronics and materials to build housing, furniture, clothing, because people aren't working as much. So domestic consumption demand is growing miserably, has been growing miserably, and that's contributed to the lack of domestic market growth and low investment because companies can't find markets for their products. And so therefore low GDP and deflation as a consequence. So yes, I know Charles's arguments. I've heard other people comment on his book, and it doesn't seem to be receive a very widespread positive or a widespread agreement, and I don't particularly agree with. I mean, I think they need to argue that which they are. Charles is arguing that the globalization, internationalization has ended, so that deflationary force isn't there, and then all you have is this kind of high wages, right? That's going to cause inflation. But I think the counter argument's been, well, you're going to still have globalization. India is coming on. The South Asian economies are coming on board, and certainly Philippines and Southeast Asia have a young demographic that are producing a lot. So that's going to continue, and that robots are going to come in and replace the labor anyway. So you may not need that much demand and any of immigration. So it's an interesting hypothesis, but I'm not too sure if it's going to be right. Yeah.
Very good. No, that's very sort of nuanced response. I appreciate that, Robert. All right, so let's cross the Pacific back to your shores. So during my visit to the U.S. last month, I heard nothing but stories of soaring gas prices and soaring costs of hiring labor. So let's get a sense of your take on the inflation situation.
Yeah. So when people are forecast, right, it's like 8.5, 9, and people have been forecasting a turn into lower inflation for the last three months or so, and it hasn't happened yet. But if oil prices are declining somewhat, and so I think simply by what people are saying, I don't know the technical term of it, but since the level last year was high, the growth, relatively speaking, the growth level is not going to raise the inflation as much. So that's going to kind of mechanically bring it down. But kind of more broadly thinking about the economics, it's clearly this administration and the central bank was very much behind the curve, and they're not even. I mean, they're raising rates at a fairly rapid clip, but because of concern about the financial markets, and I think also about the labor markets, the real rates are still negative and quite negative. Yeah, so you have like 6% negative real interest rates. So you can take overall, people think positive real interest rates are less stimulative than negative real interest rates, and you kind of still have negative real interest rates. So the stimulus today it's less than before, but it's still a stimulative situation given the actual inflation rate. So and I can't really imagine this central bank being like the Volcker central bank, and also we don't have a history of the entire 70s of having high inflation where Volcker had the background and the support to do that. So this central bank, I don't think is going to do that, and therefore you're going to kind of continue to have longer negative real interest rates, and therefore more stimulative than otherwise, and inflation could continue longer. Like you can't. So looking at this history in 1982, we had started to have these very rapid interest rate increases, and the economy started growing again in 84, 85, and around the mid 80s, combined with the collapse of OPEC and the fall in oil prices, you started to have low and stable inflation in the 85, 86. And I think the decline in inflation is going to be a little more tamed, and we may not reach 2% by 2024. we might. I think it'll be higher than that, and higher than that for longer. So if I were, the tip spread. I mean, let's say it's between 2.5, around 2.5. But I think if I would bet on something higher than 2.5 over the next 5 years on average. Yeah. So mainly because of the more accommodating, not a draconian monetary tightening, sort of more accommodating, being aware of the labor markets and the financial markets.
Very interesting.
Yeah.
So Robert, you're basically saying that the demand side impulse is not going to go away. So even if we have some favorable developments on the supply side, so oil production gets ramped up, the war in Ukraine ends, even then, you don't think the demand side impulse will go away, and therefore inflation net will remain substantially above target.
Yeah, above target. That's right. I think there's two. Economists here kind of on both sides of this. Like, there's one group who say it's supply side stuff, temporary, and China's COVID, and the other group says, yeah, but it's a combination, and someone like Larry Summers, for example, would say that it's you got to, unless you tighten money or have a deep recession, you're not going to get the inflation rate down. And I'm a little bit more towards the Summers camp on this, that you need to have a recession. Again, it's very divided. People say you don't need a recession. We really need a recession to bring the inflation rate down to target. And I don't think the demand side, both the fiscal side and the monetary side, because we're talking about even some more money, more spending coming on for the healthcare and the prescription, which I think are necessary things for the U.S., but we're not talking about fiscal tax increases, or the debate is still on increasing government spending. Yeah. So for those reasons, yes, I guess I agree with what you're saying. Yeah. That. Mm-hmm.
I suppose so. Extending that Summers Dekle argument that you need substantial rise in unemployment or a deep recession to bring prices under control, is that desirable? I mean, what would you rather have? Live with inflation or lose your job? I think most people will say the former.
I think that's right. I think that, and therein lies the political conundrum. That's exactly right. That I'm a tenured professor, so I'd rather have low prices. So Summers, but that's not good for the lovely baristas and charming waiters and the very helpful production workers. It's not a good thing. So that's and their interest should be taken into account. It's a little bit different. Again, the 80s was a different thing. The political sort of composition of the electorate was different from today. So I think now it's more diverse and younger. The younger people are much. In the U.S., one of the interesting things compared to Japan is that the millennium population fraction of the voting public is now larger than the baby boom generation. Whereas Japan, you have so many old people that the old people still kind of have political power. But here, the power is shifting to more people 30s, 20s, 30s. And this inflation is actually good for them, better for them than for us. So I think there's a shift, and politicians are rationally responding to that. So there is going to be more of an inflationary bias today than in the 1980s. And this other people have kind of commented on this, but I think I agree with that. Yeah.
Right. But that's about the political imperative. I would like to think the Federal Reserve is above that.
Okay. Yeah. That's right. But if the Fed's interested in 2% inflation, right? I mean, Fed has a dual mandate, but which makes it more complicated. But it wasn't. They didn't even have a mandate in the 1980s, so right. It was, and they still lowered it to. I think inflation was thought to be evil number one. Today it's not, and I think some inflation is beneficial for the U.S. debt as well. So, and maybe we might going to talk about emerging markets, but I think the U.S. would like to have the dollar a little weaker than it right. is currently for the U.S. economy. But still, foreigners who hold dollars, such as the Chinese, Japanese, and the Germans, I mean, the inflation is not helpful for their. You're going to have capital losses there too. So I think it's So for those various reasons, I think inflation is going to be a little elevated. I do think. I mean, being an older economist, I do think that this credibility of the Fed in the 1980s was gained at great cost of inflation and the unemployment. And I'm a little bit have mixed feelings that the credibility of the Fed as an inflation fighter is sort of quite a little bit less today than it used to be, and it's kind of that credibility is being dissipated a little bit. It looks at financial markets, and that's a very good thing. So for those reasons, I think inflation will be more elevated. But who knows? We might actually have a recession regardless of what the Fed. It might not be from over tightening, but recessions start from all unexpected reasons, and you have one, and then the problem is solved. So
right, and so we were recording this on Friday morning. On Thursday, we had the second quarter GDP data, which showed the U.S. economy contracting on the back of the first quarter contraction.
Yeah.
So I suppose it would have to start with housing. So what's your local observation? The red hot Southern California housing market, is it getting dented by the higher interest rates?
Yeah. The more higher mortgage rates have certainly dented. Like in my neighborhood, you have maybe 2 or 3% prices have fallen since its peak. You look at all over Southern California, the higher end houses are selling less. And yes, indeed. I think for the time being, housing prices have peaked and they've started falling. So they've fallen maybe like 2% over the last 2 months. Yeah, around here.
Right. And what about that component in the CPI, owner's equivalent rent?
So that would help. Mechanically, that would help. And also rents, if the economy is a little weaker, landlords can't hike rents as quickly. Right, so actual rents are not going to be rising as much, and certainly the imputed rents, as housing prices fall, are going to be lower. So that'll bring down, and the housing component's a large component of the CPI, so that's going to help bring it down. And you have energy coming down. Food's a concern that we haven't seen declining food prices yet. But.
Right. Actually, that's probably even a graver concern for emerging markets. We will talk about that momentarily. So one upshot from this higher interest rate has been this amazing, strength of the U.S. dollar on the at the expense of the rest of the world. So I was, in London. I mean, $1.19 for a pound. I don't remember that ever. And similarly, euro dollar going toward parity, and of course, more importantly, emerging market currencies coming under pressure. So to the point of discussing about recession and perhaps the Fed not being inclined to engineer a massive recession, meaning sooner or later they will relent from taking interest rates, say, past 4% or something. Is the market beginning to price that out? Is the dollar peaking, or you see further? And then if you do see further dollar strength, what does it mean for?
No, I sort of I thought it was peak. Yeah, I mean, I think it's I follow the yen dollar rate, and I think it's peaked there. 130, 3 or so. So I think you've seen, inflation should, you and I are specialists in this, like inflation should depreciate the US currency, right? You have the interest rate stuff, but that's brings in capital flows, but also simply by purchasing power parity, the old monetarist argument, that should help push the inflation rate. So and which is the desire of the Fed as well, to some extent, to a large extent. So I think I think the dollar has reached a peak or close to its peak, and that's why we're sort of upset we didn't travel this summer, because it would have been the time to go to Europe or Japan or wherever. Yeah.
Right. But I guess there are two ends of this argument. So one end, the dollar across a basket of currencies may have peaked, but the sort of narrative that we're seeing out of Europe and elsewhere, they're also falling into major recessionary dynamic. So you'll still find Europe rather reasonably priced.
I see. Okay.
The dollar not substantially weaker.
Like a week. You're right. The U.S. economy, why the dollar is stronger is partly the high interest rates, but also the real economy is stronger than Japan and Europe, and that certainly helps in strengthening the currency. So yeah.
So Robert, you and I, both as students as well as professionals through our careers, have seen every single rate hike cycle out of the U.S. being accompanied by some sort of an EM crisis, some deeper than others.
Yeah.
Are we going to see waves of default and major crises now?
Well, capital's flowing out, right? If that continues to accelerate, then you're going to have investment declining, and these countries have to start raising interest rates to defend their currencies, and so it's not a particular positive outlook. But one should also, I think, look at emerging markets sort of country by country. I think we first you and I first connected because we were working on a similar topic.
That's right.
On, interest rate defense of currencies.
Absolutely.
And these are countries, and and so we looked at. I think you and I, you work with I guess he became the governor of the Bank of Brazil, right?
Yes, Ilan, who is now the head of the Western Hemisphere Department of the IMF.
Okay, there you go. So Ilan, yes. So you and that was a great paper. And so I think ultimately it depends on the fundamentals, kind of strengths of these emerging markets. Like if their fundamentals are really strong, they're going to be able to withstand this capital outflows, higher U.S. interest rates, and but I think in those cases of these emerging, and also during the Latin American crisis of the 1980s, each country, it was not just simply driven by the high interest rates during the Volcker era. I mean, these countries really had they borrowed too much during the oil surplus of the 1970s, and their investments were not good, right? They were investing in kind of crappy projects. And that's when the interest rates rose, that's why they were hurt. And similarly, the situation in the Asian countries, right, during the 1990s. So I feel that it's not saying, oh, the U.S. interest rates have risen, capital is going to be not going to be as floating as much to our countries. They're going to go back. Well, if you have a fundamental, like Singapore is not going to have any problem. If you have a fundamentally strong economy, it's going to be you're going to be able to withstand it fine. And most of these cases, we study individual countries or regions, and they have flaws. They're severely flawed in some way, and this capital outflow just exacerbates it. I think, as far as I follow Asia much more carefully than anywhere else, and I feel that certainly Korea is no longer emerging market, but that's fine. They're fine. Japan basically is fine, and China's fine. Singapore is fine. I feel generally it seems very strong in that region. I'm not that concerned. concerned about it. And yeah. But again, I don't know. I don't know the individual countries in Latin America, for example, as well.
So, Robert, I mean, you were talking in the context of talking about the U.S. earlier that food prices have not come down. So I suppose my worry is the energy-food mix. I mean, there are manifestations of various supply-side developments around the world, but the extent of they can create distress for particularly commodity importing economies.
I think that's right, like Vietnam, for example.
Yeah. So that's where the worries are, that even this year's high energy prices will feed into higher food prices next year through fertilizer and other channels.
Fertilizer and such.
So in some ways, just like the 70s, it really begins and ends with oil. If we can get somehow oil under control, I think a lot of the discussions we're having will probably start to fade. So let's hope for that.
If oil prices come under control,
But see, even on that issue, Robert, I have a lot of conflicting thoughts in my head, because on one hand, the desire now to pump more oil, more coal, because we have high energy prices, I worry that will undermine the climate change agenda. And I also feel that, basic economics sort of dictates that you do want the relative prices of fossil fuel products to be high. Otherwise, why would anybody start investing or using alternative fuel? What are your thoughts on this?
Well, it's the usual, the argument that the market will solve the energy shortage problem and promote. It's clearly that case, but it's the pace. If you secularly expect, as we do, you have eventually oil running out and oil prices rising over 50 years, and also you have a climate problem where in that case the government needs to subsidize because it's kind of a public good, right?
That's right.
But in those cases, you can have this increase. I think oil prices will secularly increasing that will promote conservation and moving towards more energy efficient types of transportation and systems. I think that will continue, but I think it's just the pace of the rapid rise over the last year of commodity prices that's difficult to deal with, and it's not a long-term structural change kind of argument, that's more of a shock that is these disturbances are maybe hard to manage in the short run because they're not insured against these shocks. A lot of these countries, that for the reasons you mentioned, inflation, food prices going up sharply, they don't have the stuff stored, and they're not hedged with against these food and oil prices, and that's going to create a problem. So in the short run, I think these shocks, if you can smooth them, that's fine. But if you can't, I won't say that these shocks are good things because they're going to promote energy sufficiency, because that's more of a longer term thing. Yeah.
Indeed. So, Robert, earlier we were talking about, the Pradhan Goodhart thesis, that one pushback against their idea that the world is deglobalizing is that, well, there are many other parts of the world that will remain very much globalized, and we have favorable demographic to bring us, cheap manufacturing for decades.
Yeah, that's been the counter argument.
But we certainly cannot avoid the firm fact that the West is trying to divest away from relying too much on China. So all these China plus one strategies and, finding ways to push back against IP and all that sort of stuff. So, this narrative of pushback, would that undermine global growth prospects? I mean, we have been such a big beta to China's growth over the last 2 decades. Where are we going to get alternative sources of growth if we're going to start pushing China toward a corner?
No, I don't. Well, Chinese growth, it's enormous, but it's not going to see those high single-digit growth rates that it did. Right, it's going to drop 4%, which was like Korean levels. These are kind of examples that you see all first Japan, then the NICS, and then China. So its growth rate's going to go down. Go down to some extent. And, I've always been, maybe people have different views on it, but I'm hopeful for, I tend to focus a lot on demographics, but I'm hopeful for like the Philippines and the South Asian countries, and even Africa, and to take up some of this slack. I mean, I'm an internationalist, and I think the West has compared Eastern. It was a very China faced a very benign environment until fairly global environment until now, and so I hope that benign environment will continue, but there's this geopolitical issue that's going on right now. My feeling is that, as I was saying, unlike the Soviet Union, China was a beneficiary of the global system, and of a benign global system. And I think their leaders are going to realize that, what are we going to gain from kind of siding with being sort of pariahs of the international system, because they gained, and just doing this calculus of how Europe and the rest, the open part of Asia and the United States, that of where their future is going to lie, will make them, they may not admit it, but a rational actor would kind of jointly determine sort of where the global economy would, along with the U.S. and I think European countries like China would. And I'm not. I don't think it's going to head in the direction of, let's be a pariah of the global, because they benefited so much, and it's just been so good for China. Whereas for the Soviet Union, I think it's arguable where the internationalization has helped them that much, except for the oil prices and stuff. But for China, it's very clear. So I'm not that negative about China kind of disappearing from the global picture. Yeah.
So I guess, Robert,
I mean, this is again it's like the very important political economy question. I don't think anyone has an answer.
Right. Well, I guess I worry the other side of the thing, which is that it's not just a question of whether China wants to be part or not. I think the answer to that is pretty clear. They do. But the pushback that they're getting, particularly from the US and perhaps increasingly this coalition of democracies, and how that ends up worries me quite a bit. And I'm not alone. It's sitting here in Singapore. There are others also who worry that countries also get sort of, pulled and pushed between these two great powers, and how that sort of gets in the way of investment and so on.
Yeah, but there's no doubt about that. Yeah.
But I'm glad that you still are sort of, pinning your hopes on rational actors. That's what we need.
Right.
Robert Dekle, thank you so much for your time and insight.
Good. It was really, really great talking to you. And don't be a stranger. I'll see you in LA. Yeah.
I will try to make this happen. Thanks to our listeners as well. Kopi Time was produced by Ken Delridge from Spy Studios. Daisy Sharma and Violet Lee provided additional assistance. Kopi Time is for information only and does not represent any trade recommendations. All 81 episodes of the podcast are available on YouTube and on all major platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.